So let's say good morning. It's week 9 on financial management. Okay, we're going to have a quite intensive class today. We have 2 chapters to go over, or 2 topics, let's say. We need to talk about the dividend growth model, and we will talk chapter 7 of your book, and we're going to talk about chapter 8, which is the decision-making tools. Okay. I might skip or go very fast on chapter 8 because chapter 9, which is decision making, that would be applying what you learn in chapter 8. So just to situate you here, chapter 8 shows you the decision making tools that we have out there. So we have the NPV, IRR, we have payback method, profitability index. So we're going to be seeing all those methods. Chapter 9 is going to show you a problem, beginning to the end, where you have to then apply the decision-making tools that we learn in chapter 8. So 9 and 8, or 8 and 9, are complementary. So I'm going to kind of use the lecture on chapter 9 to explain or give you more feedback on chapter 8. Okay. In chapter 7, I'm going to try to do a quick here because, again, it's called the dividend growth model, right? The DGM. It's a tool we use to predict the fair value of a stock, let's say, okay, or how much would be the fair value of a stock based on some assumptions. Okay, and because it's based on assumptions, we might have imperfections on the calculation. Okay. There we go. I'm better. Okay. Any questions before I start? Anything? Comments? No? All right. Informing you that your midterm grades are posted. All grades are posted. Okay. So that, again, if you have any questions related to that, you don't need to ask me in class in front of everyone, but you can do it after the class today when I dismiss everybody, or you can set up an appointment to discuss that, or even send an email, up to you. Okay. All right. So without further delay, let's start. I'm going to start with Canvas. My friends, let me know if you don't see Canvas. Okay. Make it here. All right. So I remember we went over. So let me give you an overview here, and then we go straight to the point, taking care of the assignments of week 7 and week 8. So we had the first exam, which includes 3, 4, and 5, plus the cash flow statement. Now the next exam, which is next week, okay, week 11. Week 11, yeah, it's wrong. That should be, yeah, week 10. Okay, week 10 is your exam. And I don't want to postpone unless if majority of you would like that. Okay, I don't find a good idea to postpone exams because it always includes a little bit extra if you do it. That's because you cannot be behind, right? Unless if I'm not able to lecture, then I will make that change. But so far, exam number 2, it's going to take place next week. Same style, same idea as the exam number 1. Okay. All right. I'll make it more visible here. All right, friends. 1 second. Perfect. All right. So let's see. Stocks. Okay. Chapter 7. Classwork, homework, a lot of problems. Okay. Let me add the answers here for you. Publish. Done. Okay. Answers are posted. So, but that's not enough, obviously, right? We want to start doing, we want to make sure that we do here that you understand how those answers are. Okay. So just quick before I show the answers. Okay. We're going to talk about the DGM, dividend growth model. Okay. It's used to find the fair price, or how much more or less should be the fair price of stock based on assumptions of dividends and the growth of those dividends, taking in consideration a required return determined by the investor. Okay, so we need three elements here. We need the dividend, we need the growth rate of those dividends, and we need the expected return that the investor wants in that investment. Okay, so those are the variables that we need to address on that model. The problems are relatively simple. You're going to get the instructions, you're going to get the data, and you're just going to have to plug into the formula. Okay, it's a simple formula. Okay, but in the end, it's going to give you an idea of how much the price of the stock would be. Okay, another thing before I show the answers that you should pay attention is that stocks, the dividend, excuse me. Okay, that must be the one that will be paid next year, which is called the D1. Dividend 1 is the dividend next year, versus dividend 0, D0, is the dividend just paid this year, or the most current one. We don't want the most current one on the formula. We want the next dividend. So those are the tricky questions that if you take an exam, for example, if you want to do a finance exam, okay, for a license, for example, okay, such as the CFA exam, okay, you may face this type of question there, where the question give you the past dividend, the most current dividend, but does not give you the next dividend. And you need to figure this out, reading the problem very carefully and not making that mistake. Because remember, when you're taking a license exam, usually is multiple choices, and they will put the wrong answer there based on the fact that you did not read the question properly. So you might think that, you know, you found the answer because you computed, the answer was there, you most likely thought it was correct, and it wasn't. So just be careful with that. Okay. All right. So let's see what do we have. All right. So we have classwork 5 and 6. So allow me, again, I'm not going to go over every single one of those assignments here because I'm not going to have the time. The answers are posted. I'm going to select the most challenged or complex ones, the ones that could be candidates for the exam. And explaining those, most likely we explain the short problems, right? Because they're complementary. All right, problems 2, 3, 10, and 12 for classwork. And then problems 4, 5, 8, and 11 for homework. And I gave you a couple critical thinking questions, okay? I'm gonna see if some of those are relevant to make a comment here, okay? If not, the answers will be posted, and then you check, and then let me know if there's any issues related to the answer you provided to the assignment versus the answer posted. Okay. All right. So let's go 1, 2, 3, 4, 10. A lot of problems. 2, 3. All right. 4, 5, 8, and 11. 2, 3. Well, it's a lot of problems. So again, I know for a fact I'm not going to be going over every single one of them, just few of them. So remember, for the exam, I insist, right, the next exam, because I want you to do well, you will need to remember the formula, the dividend growth model formula, and you're going to need to remember, okay, you're going to need to remember the concept of dividends 1 and dividend 0, the next dividend and the most current dividend. All right, I don't have the answers in the format that I like, okay, but that should give us a at least an idea, okay, on how to do. All right, so everyone check your files. So the ones you sent to me for assignment, if you want to get the proper feedback. If you don't want to get the feedback, right, then it's up to you. I want to remind you that you are the one paying for this class, not me, okay? So if my job is to provide you the feedback and explain properly and explain it to you how to do those problems, but again, it's up to you to do it or not. Okay. All right, just 1 second here. Let me clear a little bit. There you go. All right. So I have few answers here. Okay. For few problems. Okay, that I want to address in class. And then the other ones, I will post the answers that I have, the file. It's a Word file. And then you check and you see if there's any discrepancy between your answers and the answers posted. And then we can address that either by email. You can set up a meeting with me directly, or you can address that next class. Okay. Right. So let's see. Problem number 4, problem number 5, problem number 8 I have here in my list. Okay. So let's see problem number 4. I don't have the question here, but again, based on the numbers, I will not need it. Okay. All right. So let's see. I insist on this concept here. Okay. Very important that you remember. I'm going to put this in green here for you. Okay. And even highlight. Will pay is the D1 dividend. The just paid is a D0 dividend. Okay. All right. If the problem gives you D0, meaning the company just paid dividends of X dollars per share, that's just paid means past dividend or D0. Okay, you can see also as a current dividend, right?
I have a question.
Abshiro, please go ahead.
Are we supposed to be looking at Excel right now?
Thank you very much. Yeah,
I can't see it.
There you go. It's happening again. All right. Thank you. Thank you very much. All right. 1 second. It's still not too bad because I have not. There you go. I think that should be better now. Let me see. All right. So now I hope you can see a little bit better the spreadsheet I'm putting here for you. I'm on problem 4. Okay. All right. Back here. And again, I insist, I'm talking here for exam, okay? Because I'm sure most of you want to do well in the next exam. So for exam purpose, okay, be careful reading the problem. The will pay versus the just paid. If it's will pay, nothing changed, you apply directly the formula. If it's just paid, you need to make a little change before you plug the numbers into the formula, okay? Which number? The dividend. All right. So problem 4, the dividend, okay, here, it was given to you, I believe, as 365. So if it was given as will pay a dividend of $3.65, okay, then perfect. Take the $3.65 divided by the return expected or expected return given in the problem minus the gross rate of the dividend also given in the problem, close parenthesis, press enter, and that's the answer. That the fair price of a stock that will pay $3.65 in dividends next year, I expect to make 12% return on that investment. The company promised that those dividends are going to grow 5.1% every year. Then the fair price is $14.66. Okay, that's simple. Now, how effective is this? Well, honestly, as a professional of the financial market, as a financial analyst, I don't rely on this formula to make investment decisions. Or let me rephrase that. I do not rely only on that formula to make investment decisions. I can use as a complementary way, okay, to predict the fair value of an investment, in this case, the stocks. All right, that's it. So what you need to remember is, once again, the formula P equals, okay, D1 divided by R minus G, with R being the required return, and the G as being the gross rate of the dividends. All right, and that's it. I want to call your attention for one little thing here. Also using problem 4 as my example. Okay, I'm highlighting here for you. I'm in a different color here. I'm going to make very, very colorful my work today here, so to stress the points, right? We can rearrange the formula of the dividend to isolate it for the required return. Okay, few questions will ask you, what is the required return on a stock that's priced at this much, will pay this much dividend, and the dividends are going to grow at this particular rate? What is the required return? Then you can, if you skilled enough in mathematics, just you can use that same formula there, and then you figure it out R, which will be the unknown on that equation, right? But if you want to spare that time and just memorize or write it down another formula, which is not another formula, but it's just a rearrangement of the previous formula, you can. This formula here predicts the interest, the required return that an investor will require on buying that stock, right? And so expect a similar problem like that on the exam, okay? Very straightforward, so you want to demonstrate that you know how to apply the formula, okay? And you know what's the purpose of that formula, okay? This menu here is bothering me a little bit. There you go. I think that's now a little bit better. Okay, all right. There you go, friends. I'm moving on. Again, this is the problem that I want you to feel comfortable, because it's a pure application of the formula, right? And it will be in the exam. All right. I'm going to talk about problem 5, because problem 5, okay, it's the same one that I mentioned before in terms of the required return. The problem is asking you not only to what is the required return, but it's going a step further. He's explaining to you, or the problem 5, try to see if you understood that the required return has 2 components. That's also material for the exam, and I want you to pay attention here, okay? A required return, and it's actually good for you as an investor to figure it out, what is included, right, on your required return, okay? So on your required return, okay, which is this guy here, you have 2 components, right? One is the return you get on the form of dividends. So if the stock pays dividends, you make money, that's a return. And on top of that, you have what you call the capital growth, right? Return, or capital return, meaning is the price appreciation of the stock. So the stock goes from 10 to 11, appreciate $1, that's your capital gain, okay? So the required return is divided into components. Right. You need to know that for 2 reasons. One is because you want to know how much money you're making on dividends and how much money you make in capital appreciation to make a decision later on if you want to keep the stock or sell the stock. That's one. And second is because you're going to be taxed in 2 different ways here. Right? Dividends are taxed in one way, capital growth is taxed on another way. And it's pointless for me to know how much it is, because each government in power will try to change those rates, okay? So if they decided that dividends are should be able to be taxed more than capital gains, then the tax rate will change, so on and so forth. It changed from countries to countries, so it doesn't point, it's not much relevant to know exactly at which level we are, okay? But it's definitely above 20%. All right. What is the dividend return? That's to complement the answer for question 5, which was not supposed to take a long time, but I'm taking my time here because I think it's important, okay? So here we have here, friends, the dividend return is nothing more, and I'm going to write down here, the dividend that you're going to receive divided by how much you paid for the stock. Okay, so this is called a dividend return, but we don't want to use the return here. It's just a convention. We use the word yield, dividend Killed. Done. And then the second portion of your return comes from capital appreciation, okay? Capital appreciation is just the change in value of the stock, okay? The change of the value of the stock equals the growth of that stock, the growth rate. So the growth rate given on the problem, it's equal your capital gain, okay? There you go, all right? So the growth rate, the G, right, the growth, is capital gains, and D, dividend, D1 divided by P is your capital, is your dividend return. When you combine those two, you get your total return. So there you go. That's the question number 5 on chapter 7. Okay, all right, take a look, because this will be in the exam. You're going to be tested on the components of the growth rate, because that's important to know. Okay, again, any questions, stop me right away, okay, or raise your hands, man, if you want to do that, fine. Otherwise, I'm going to keep on going. All right, let's see one more, okay, before we start getting too repetitive. Okay, and then I'm going to talk about P11, which is a little bit more complex than the previous problems. It's important to know. Okay, let me make it a little bit more visible here. There you go. All right, friends, problem 8 now. Nobody asked anything about the previous two, so keep on going. Problem 8. All right. Dividend is $3.88. And be careful here, okay? We are, the growth rate of the dividend is in perpetuity. Perpetuity means that there's no growth rate, meaning you're going to get exactly the same dividend. It's called a constant dividend paying in the same amount forever. Okay. Now be careful is that if you're the company and you promise one of those dividends, okay, and you don't have money to pay, you're not going to be obliged to pay, right? If it's a promise, right? But all the dividends that you haven't paid in the past, you must pay once the company starts making money again, right? Start being financially stable again, right? So again, paying the dividend, even if it's a promise, you don't have to. You're not going to be liable if you don't pay every single year, because the company will face eventually financial distress, temporary financial distress. And they don't have to pay dividends in that case. But if they promised that they would, then they have to pay once the company gets back, the financial position start improving. All right, perpetuity is a very simple problem because there's no growth rate. All right, the question here made a little difficult for you because the problem gave you the dividend, constant dividend, and gave you the price, which is the price that the stock is selling. Okay, so and then if you want to use the same formula we've been seeing so far, okay, this formula here of the P equals D1 divided by R minus G, sure, then you plug what you have in the problem and then find the unknown. Okay, that's one way to avoid memorizing additional formulas. Okay, so look at if you're doing this way, P is 78.45. Equals to 3.8, which is the dividend. It doesn't make sense to call D1 or D0 because the dividend is constant, so it will always be the same. Divided by R, which we're looking for, minus the growth rate, which in this case is 0. Memorize that a growth rate in perpetuity usually it has a constant dividend. Okay, all right, isolated R, and you get 4.84 or almost 5%. Okay, there you go. Here's make it a little bit more visible for you. There you go. So the answer here is that if you buy a stock that pays $3.80 in perpetuity and you pay $78.45 for that stock, you should expect an annual return of $4.84. Okay, a decent return. We don't know the risks involved. 4.84 a year. If it's low risk, seems decent. Not marvelous, huh? But decent. All right. I haven't checked, and I'm not going to have time to check the stock portfolios of each one of you, the stock portfolio assignment, but I'm sure the number one is making more than 484%, okay, on that ranking. So although the students playing the game, playing the stock market contest, right, I'm sure the first place is higher than 4.84 or 5%, okay? All right. On my other class, the first place is making 15% at the moment after 3 months of trading. 15% return on 3 months of trading. It's an excellent return. If you make 15% a year, is already excellent. Imagine 15% in 3 months of trading. Just to give you a perspective here. All right. Stock market is very volatile, a lot of volatility. Cryptocurrencies are a lot of volatility. So again, you start placing your bets. You guys should take some risks at this point. You're young, nice. Take some money to spare, buy some stocks. All right. Again, that's problem 8. And problem 11, those are the ones I'm going to go over. If there's any other problem you'd like me to go over, let me know. Otherwise, I'm going to jump to chapter 8, okay? And 9, which is the topic of today. All right. Problem 11, be careful, because it also could be a candidate for the exam because it's an interesting problem. It's a stock that does not pay dividends for X number of years. So in this case, it's a stock that does not pay dividend for what we call a 20 years. 20 years, so no dividend year 1, no dividends year 2. Look at that, 0, 0, 0, 0, all the way to year 20, when that stock will pay the investor, okay, the stock will pay the investor $20, okay? So $20, $20, $20, constant dividend, okay, after that. Okay, so how do you figure it out the price to pay today, okay, of that stock? So it's a simple logic here. Step 1, compute the fair price on year 20. Okay, compute the fair price on year 20. Why on year 20? Because that's the first year that the stock's going to pay dividends. Then, once you have the price on year 20, bring it to the present to figure out how much should you pay today. So that's what we're doing here. So look what we did. The formula is dividend divided by return minus gross rate. It's a constant dividend, so the gross rate is zero, right? Therefore, the formula is dividend divided by required return minus 0. $250 will be the price of that stock, which seems logic if you're going to make $20 a share. It's a lot of money, $20 a share, right? You have 2,000 shares. If you have 5,000 shares, okay, and you get $20 a share, if it was every year, it's $100,000 a year. It's a decent, it's not a super good, but it's a decent retirement, $100,000 a year. Okay, it's very decent, okay? Especially if you have most of your expenses paid. Okay, and I say decent, and you might say, "Oh my God, $100,000 is a lot of money." Well, it's decent because $100,000 today in the U.S. For a couple, it's not that much. It's not that great of income, $100,000 combined income, not at all. Right? I know you're starting your career, so you might be making less than that, but I'm telling you, when you're in your middle career, you should be making at that time the equivalent more than $50,000 per member of the house, right? If it's the partners, the combined making 100,000, it's not that great. Okay. The rule of thumb is that combined incomes of 150,000 today, it's decent. Okay. But less than that might be critical. All right, but again, this is for another class. I'm going to focus here. So look at that. $250 is the fair price on year 20. How do I know the fair price today? Bring $250 20 years from now to today. It's a simple present value calculation. I hope you can see there. I'm going to click on the bar here. hold on. And if I don't know if you can see, they're highlighted for you, equals minus PV, present value, of 8% for 20 years, no payments, because there's no payments happening. It's a simple present value computation. Future value 250, press enter. You can do that on a financial calculator. You can use the HP 12C, you can use the Texas, or you can use Excel. All right? So answer, pay $53.64 today, wait 20 years, and start making $20 in dividends per year until the end. All right, and that concludes problem 11, friends. It's an interesting problem. Good candidate to be on your exam. All right, this takes me to half an hour. That's what I had predicted to give you the feedback on this chapter. Now I'm going to go to chapter 8, okay? Do a basic overview, and then I go to chapter 9, topic of this week, okay? Investment decisions. And during my explanation on chapter 9, I will address more of chapter 8, okay? That's what I'm going to do. That's what I had planned for today. All right, good. So let me stop sharing here for a sec. For a sec, actually, not true. Might be a little bit more than a few seconds. All right, and let's go back to Canvas, my friends. All right. All right, we're done here. All right. And then we have some homeworks already addressed. Critical thinking will be posted for you, okay? Most of those critical thinking questions that I assigned have already been answered to you, okay? All right. All right, so now let's see what we have for this classwork for chapter 8. Let me just go there. All right. So homework solution for chapter 7. Let me make it available for you now. So now, friends, we have the answers for every single problem on that chapter for you. All right, moving on. Chapter 8, investment decisions. An interesting chapter. I like this chapter because it shows you interesting decision techniques, easy to use when you have Excel or a financial calculator, very easy. We use an Excel in this class, so that should be a no-brainer, right? It's just pure memorization of formula, not even a pure memorization of formulas, not even that. It's just to know the name of the formula. That's all you need. Because once you put the name of the formula, equal, name of the formula, open parentheses, then Excel is going to ask you for all the variables. So you don't even need to remember the order of the variables into the formula, right? Excel is going to give you that clue for you. So it should be very simple to do those assignments, okay? So let's make chapter 8 available, because this one, I do not have an Excel file for it, okay? Because I thought it would be much easier to use the Word on this case here, okay? All right. Let me see what we have. What are the nominees for chapter 8? Waiting a little bit. Do I have that? So slow today. It's apologies for you. Believe is the connection. Very, very slow. All right. Okay, so we have 3, 5, 7, and 12 on chapter 8. I remember those problems. They are few of payback, few NPV, and I think 1 or 2 IRR, internal rate of return, excuse me. I have the IRS in my mind, Internal Revenue Service. It's because I have not received my refund yet. Right. I know it's on time still, but it's IRR, Internal Revenue, Internal Rate of Return. I did it again. No? Internal Rate of Return is the amount, is the percentage, minimum percentage to required as a return to make that investment to break even. right? It's a very important concept in finance, the internal rate of return, or IRR. Right. In assignment 9, I gave you quite a few problems here. Oh, chapter 9, that's next week. All right. Good. So let's see what we have here as answers. Come on, friends. Let me make it a little easier for us, shall we? There you go. For chapter 9, friends, while I'm opening this here, I'm preparing you for chapter 9. It's very important that you have Excel. If you want to follow me here, chapter 9, you're going to get one problem in your next exam. It's a complex problem. It's a time-consuming problem, okay? It's only one problem that if you don't pay attention, you make one little mistake, right? Then it's going to be critical and you're not going to get the right answer, and then you're going to miss points and you're not going to do well in the exam, right? It's a 25-point problem on your exam coming from chapter 9, okay? Project evaluation, yeah, which is this one here. Yeah. All right. The homework solution I thought I had here. I don't. All right. And again, I would be very surprised if most of you, if not few of you, had problem with the problems here, right, on chapter 8. Oh no, actually I'm going to use, I'm going to use a Excel document here. Let me know if you don't see it. I'm going to show on Canvas because until I open Excel, the way that that's a little bit slow today, the connection, it might be a little bit too much of a waste of a time. All right. So let me explain to you here the basic concepts of IRR, NPV, etc. Let me see if there's any payback here. No payback questions. You know what? Change my mind. Change my mind. It'll be more effective at this point if I do it this way. All right, friends, I'm going to share Excel with you. It'll be more effective. Okay. And then I post the answers. Yes, matter of fact, I already posted. Then you can check. And if you have any questions, then we can address that via email. We can address that via a one-on-one Zoom call. Okay, or meeting. All right, so let's talk about chapter 8. And right here, I'm gonna put chapter 9 because, like I said to you, they are a big chapter. Okay, and I want to spend some time on chapter 9 today. All right, chapter 8, friends. So what it is? So we learn about the NPV, we learn about the IRR, and you learn about the payback method. Right? That's what we learned, or that's what you've seen there. And then you had others, right? You had other decision-making tools, meaning if I use those, I can be certain that the investment I'm going to make is, is going to give me money or it's not going to be profitable. Okay. We have the profitability index, which is a first cousin of the NPV, okay? Except that NPV give you the answer in dollars and the profitability index give you the answer in a percentage, right? And you also have what you call the accounting rate of return, okay? Which also, I'm not gonna focus much on this class. So let me highlight the 3 ones that I think you should know. I think it's important for your exam. There you go. NPV, IRR, payback method. All right. How is the NPV? Look at the formula here. Okay. Equal NPV, open parentheses. If you do equal NPV and open the parentheses, right? Look what happened. Can you see? It highlights the variables that you need. The first variable is the interest rate. Put it there, put a comma, and then put the cash flows. all the cash flows given on that problem. You can put one by one, or you can put it on the spreadsheet and then highlight it, okay? The whole range of cash flows, okay? So here you're gonna put equal NPV, okay? And here you're gonna put the interest rate, comma, you're gonna put cash flow 1, cash flow 2, cash flow 3, all the way until your cash flow N, the last cash flow. But be careful here. That's the NPV formula, okay? And if you press enter, okay, when you press enter here on that formula, friends, this means that you will, let me get rid of those little things here. This means you will get how much money, if it's a positive number, how much money you get as profit, okay? Or if it's a negative number, okay? If it's a negative number, then you know it's a non-profitable project, okay? So that's pretty much the idea here. Now, you have to go a step further. Here, you're gonna have to go a step further. The step further is that we don't wanna know the net, the present value of the cash flows. We wanna know the net present value of those cash flows. So because of that, you're gonna have to minus the initial investment. Eric, take a look. So that's the formula of the NPV, okay? I'm gonna make it a little bit more visible, okay? Easy to read, I meant, but that's what it is. So it's NPV, open parenthesis, the interest rate, okay? Cash flow 1, 2, 3, all the way, close, minus the initial investment. Okay, the minus initial investment is not in the formula. You have to add it when you're doing. Otherwise, you're not going to get the right answer. IRR is a little easier to set up the formula. Okay, it's a equal. All right, this one, yeah, equal IRR open parentheses. Look what happened. He's asking you for values only. I forget about the gas, right? Just values. Which values? The cash flows. All the cash flows. So all you have to do here, and I'm going to show the example, okay, is all cash flows. So here you're going to put cash flow 0. Which cash flow 0? What is the cash flow 0? Your initial investment. That has to be the first one. And then cash flow 1, cash flow 2, okay, all the way to cash flow N, the last cash flow. That's it. Press enter and you get the results. All right. So it's quite easy to use the IRR formula. All right. Notice that the initial investment on the NPV, okay, notice that on the NPV, the initial investment is outside the formula, outside the parentheses. And on the IRR, okay, your initial investment, right, is this guy here, is the CFO 0, okay? And that CFO 0, I'm gonna put here in green, see if you don't know if you can get, yeah, the CFO 0, cash flow 0 is your initial investment, so it's right there, okay? Payback method, you just take your initial investment, so initial investment minus the cash flow 1 minus cash flow 2 until the investment pays back. II stands for initial investment. I'm going to write it down. Initial investment. That's more or less the idea here, okay? Take the initial investment, and then every year that you have a cash flow, you minus from the initial investment, keep on doing until you get to 0, means you recuperated your initial investment. That year is your payback year. That's when the investment pays back, and then you find if this is too long to wait or if it's appropriate to wait and make that decision. All right, I'm going to go back to the question on the IRR the student had asked. Please ask your question.
I did the formula and it said it was like an error, but
okay.
I don't know if I put it in right.
Sure, I'll explain. I have a pretty good idea why you got an error message, but let me see. Let me give you a quick example here how the IRR formula will give you an error message. For example, okay? I'm going to explain during chapter 9. I'm going to give you a more comprehensive example, and then you're going to see this again, but I want to address that question. So the just finish here, profitability index and accounting rate of return, okay? We mentioned, I gave you a lecture last class, okay? But that's not something that I will focus much on the next exam, okay? So those ones here, I already provide you an explanation for it, but they will not be critical for our exam, okay? So those ones here, let's put them a little bit on a dark color. All right, so let's see the IRR example here, friends, okay? So chapter 8. So let me give a very, very simple example. Let's say, okay, on year 0, the year of the investment, let's put it here, okay, on year 0, you're gonna have to pay, okay, you have to invest, let's say $100,000. Now, $100,000 is negative. That's one thing here for the student asking the question. If you don't put a negative number on your initial investment, okay, you might get a wrong answer, okay, on the formula because Excel will imagine or you understand that initial investment is money that you have to pay, right? And cash flows are the money that you are receiving. So because that pay is one direction, receiving is on another direction, we need the negative sign on the formula to apply on Excel, okay? And let's say year 1, my investment is gonna give me $20,000. On year 2, I'm gonna get, let's say, $25,000, okay? On year 3, let's say I'm gonna get $50,000, okay? All right. And on year 4, I get another $20,000. Let's say that's my project, okay? That's my, that's what I wanna invest my money on. All right, now this product might look, you know, let's say what do we have here? If you don't, how approach a problem like that in real life, let's say, right? Try to add the cash flows first without doing anything, just add the cash flows, right? And see how much you get here, right? So we'll get here, what, 50, 75, 95, you have over 100,000 in cash flow. So that seems an appropriated project. You're gonna pay this and you're gonna receive that. Right. Now, then therefore it will pay back sometime on year 4. So that would be answer the payback method. Okay, you just say, well, it pays back sometime on year 4. That's enough. There are ways for us to compute precisely when on year 4 you're gonna get paid, but that's irrelevant when you kind of just doing a basic analysis. Payback method, it's not something you want to spend too much time on doing. You're just going to use this as an initial method to separate the good project from the bad project, and then you do a more comprehensive evaluation using those two methods here. All right, so let's say that's the example. So look at that. Let's do the answer here. So the answer will be, what is the internal rate of return for this project? Meaning, what is the required return that I should ask, me, the investor, if I want to make exactly $100,000? That's how much I'm paying for, right? So if I want to get back exactly what I paid for, what required return should I ask? That's what the formula will answer here. So let's see. Equal IRR, open parentheses, and just highlight the values, just like that. Just highlight them. All right. And then if you want to give me 2 decimals here, okay, if you want to give me 2 decimals, that's fine. Okay. Or if you want to round it, that's fine as well, but that's the answer here. So now let's interpret this answer, okay? Let's interpret this answer here. 5.56%. And just to let the student know, I will be arriving on the situation when I'm gonna get an error message. I'm just making a point here. This means that 5.56% is what you require, okay? You should require if you want to break even. If you believe that this project, right, you'll be happy with 5%, 4%, or 3% return. If you're happy with that lower return, then it's a good project. However, if you think that the risks associated to this project here, you deserve more than 5.56% return, then it's a bad project. That's how we analyze the IRR, okay? Now let's come up with an error message. If I don't put a negative number here, I usually get an error message. There you go, see? So I don't know exactly if that's what happened, but that could be one reason why your IRR computation will be giving you an error message. All right. So would you, the student will be able to share if that's what happened? Or if not, then I have to figure it out something else here.
Yeah, that's what happened.
There you go. Perfect. Good. And that goes as a feedback to everybody, okay? If you forgot to put a negative number, if you don't put the minus here, then you're not going to get an answer for the IRR. Very good question. I'm glad you asked this question because that's something that could happen. Imagine if you're doing an exam for a license or something, right? Like the CFA exam, for example, or a Series 7 that you have to demonstrate it. I don't know why Series 7 would ask this question, but definitely the CFA exam would. And you're doing and you forgot the negative sign and you keep getting error message, and you have just a few minutes to answer each question. That can be very stressful, right? So understanding how to use your financial calculator or any tool you're using, it's essential. All right, friends, this will be my feedback on chapter 8 for you, okay? And then wait for the answers to be posted, and then we can address more questions on those assignments next class. Or again, during the week, if you wanna email or set up a meeting, okay? Other than that, I'm gonna go to chapter 9 because I have 20-something minutes onto the class, and I wanna spend that on chapter 9. All right, good. Right, I guess let's go. All right. So chapter 9, okay, on your book, okay, investment decisions and cash flows. Okay, so what is this? Well, this is that we're going to have to apply those formulas, IRR, NPV, okay, payback method, if you want to consider that as a formula, okay. We're going to have to apply here in a comprehensive, complex problem, let's say, right? In a problem, okay, that makes it more easy, right? I would say, or not easy, but makes you to see the application of the formula, okay? So let me make this a little bit more visible here. There you go. I'm gonna share, what I wanna share with you is Excel. So let me know if that's what you don't see. I want you to see like a blank, kind of not completely on the screen, but you know, partial of it. And I want you to see that, there we go, thank you. That's what I want you to see, okay? Let me know if you don't. So you should be seeing there, chapter 9, investment decisions and cash flow, right? That's it. Now, let me use the previous chapter homework as a way to start this. All right, friends, so look at this. On chapter 8, a couple of things are given to you. The cash flows are given to you, okay? The initial investment was given to you, and the required return was given to you. What you had to do? Apply the NPV, the IRR, and the payback formula. So I would say not difficult to do that, right? Once you already know how to use the formula, not difficult because you just have to plug the numbers, okay? Paying attention to what I just mentioned before was the negative number on the proper place on the formula, but other than that, is a pure application of a formula. Now, what happened if you do not have, what happened if you do not have those two items here, okay? Then become a little bit critical, or a little bit more of a challenge to do the problem, right? But obviously, that's what you have to do in real life, right? If you're working with this is a capital budgeting. I put it here. That's what the branch of finance that studies or addresses the NPV and the cash flows, okay? The capital budget will be the topic. In chapter 9, investment decisions and cash flow under capital budget. All right, so let's see one by one here, friends, because this one here is not difficult to determine on a problem. This one is a little bit more complex and is going to require you to remember the formula for the cash flows, which we learn in U. I teach this class, so I know it's a prerequisite for this class, so I know you have seen this before in financial accounting, cash flows. Also managerial accounting, okay? But financial is a prerequisite for you being in this class you are now. Therefore, I'm sure you have seen this, okay? All right, so let's see. Let's start with a simple example, shall we? All right. So that's an example like this. The company wants to expand. That's the problem, an expansion, okay? One, how much is going to cost initially? How much is going to cost on that expansion? Right. So it's going to cost what we call the initial outlay. Okay. What is the initial outlay? Is the initial investment? Is how much in cash you need to start this? So that expansion, let's say, needs the initial outlay needs. Let's just make our example simple here. Okay. You need to buy fixed assets. And the fixed assets may include a building to the operations, machines, equipment, etc. You're going to need to buy fixed assets. Let's say you're going to spend here to buy those fixed assets $500,000. I'm going to put this as a negative 500,000. Okay, negative $500,000. Okay, why negative? Because you're going to have to pay for. All right. All right, and then what? Now is the time that the problem is going to give you a lot of variables. Okay, I have an example to show it to you, but before showing that example, let me do a brainstorm first. Okay, it will be more helpful. All right, then the problem is going to say, if you invest 500,000 in those machines and in the new factory, etc., on year one, okay, your sales, okay, I'll actually put a little bit different here. The sales, okay, will be on year one, okay, will be, let's say, $50,000. Okay, let's say on year two, that sales is going to increase to $100,000. And I'm going to make my problem very simple here, okay, because I'm just addressing, and then there's a more complex for homework. Okay, let's say on year three, it was very successful, very, very good, and we made 400,000. All right, so that's my cash flows. Excuse me, liar. Those are my sales. Okay, for if and only if I expand. So those are called additional sales. Okay, incremental sales. That's a proper way here. Incremental sales on year 1, 2, and 3 in those amounts. However, you're also going to have incremental costs. Okay, the incremental costs, let's say for year 1 equals, let's say, is going to be 10% of incremental sales. Okay, just to make it easier. Let's not even put year one. Let's put here all years. It's going to be equal to 10%. Okay, try to follow me here, people, because those problems on investment decisions, there's a lot of variables to address. I'm doing a brainstorm first, and then I'm going to show a template, which I strongly recommend you to do one, to make your life easier for assignments and exams. Okay, the template you can use during the exam, the template I'm going to show it to you soon. Okay, all right, and what else we have here? Okay, let's say that you're going to have inventory requirements. Okay, they're going to be equal to 5% of your sales. And we could make our life way more complicated here. We can say inventory requirements for year 1 and 2 will be this much, for year 3 and 4 will be this much, or in this case we only have 3 years, right? So for year 3 so we can make it very complicated here in terms of variables, right? That you need to observe and include it on your analysis. I'm not going to make it too difficult yet, right? I'm not going to make it super difficult at all, but during the lecture, I'm going to make it simple. All right, and then the inventory requirements, okay? And this information is important to know, okay? The depreciation of new assets is going to be equal, let's say, to 1% of sales. Okay. Okay, let's stop here. Okay. For now, and let's try to digest this problem, and then I'm going to show the template. So then is advisable for you to build the template as I go. All right. I'm going to make a template with more lines that this problem has, because that template can be useful for the class assignment or in the homework, which are more complex. Okay. All right. So take a look on the problem. You're going to invest $500,000 today. Okay. And this is going to help you to make $50,000, $100,000, and $400,000. Okay. Not units, dollars. Okay. On sale. Let me put a symbol here, so you know this is money. All right. But on sales, you have costs. Let's say costs and expenses combined. 10% of the incremental sales. Remember, you only have 3 years. Inventory requirements for this new expansion, because you're going to sell products, right? Assuming this is not a service business. 5% of the sales. And the depreciation of the new assets that you're going to purchase to expand, 1% of the sales every year is the depreciation. Now let's combine all those numbers into a table. And in the end, what is that we want in the end? In the end, you want 3 variables. Okay? Variable number 1, the initial investment. Excuse me. Variable number 2, you wanted the cash flows. And variable number 3, the required return. Now, could we determine the required return using a formula? Yes, absolutely. Okay, we're going to address that when we talk about the WACC, weighted average cost of capital. It's coming in a few weeks. For now, it's going to be given to you. So the required return, you don't need to compute. It's going to be given on the problem. So I'm going to put right here that the return, the required return for this investment equals 15%. Just, again, I gave this number, I decided, okay? Again, it is possible for us to compute the WACC, and I'm gonna show how this is done. WACC stands, let me put it here, for those that never heard it before. WACC, it stands for weighted average cost of capital. What's cost of capital? Is how much it costs you to borrow or to have this $500,000 here, for example. That's a capital. How much is going to cost you? What is the risk involved to get it, et cetera, et cetera? We incorporate that into a rate of return. That's the rate of return that we usually use. Okay, so it's called the WACC, weighted average cost of capital. Put this name on the side for now, because we're going to discuss that in a few weeks. Okay, for now, the rate of return of those problems will be given to you. Okay, you don't need to, you're not going to face the WACC in your next exam, it's only on the final exam. So for the next exam, the required return will be given to a problem like that. Okay, all right, so let's continue. Let's now create a table. Very useful table here, and you can use this as a template. Okay. Now, I suggest you to use as a template, to create this template, because I'm not going to post that for you. However, when I provide you the answers for the assignments next week, I most likely will post a table on Canvas. It's going to be on a PDF file, so you can copy the lines, etc. according to, so you don't need to do now if you don't want to. All right, but let's do it. What is the first step? You start with your sales. Okay, and put this one below here. There you go. Start with your sales. Okay, and then you do the years. You do year 0 for your first year. Okay, that's not really a first year, but that's now, right? How much you're gonna spend and make now. And then you have 3 years given on the problem. You have year 1, year 2, and year 3. Okay. Obviously, in real life, you could have more years, but we're not going to make our life difficult here, putting 35 years, because it's going to be time consuming, right? To explain the point here for you. All right. And then, my friends, the next in line will be your costs. Okay. And I'm going to put as minus, okay? Minus costs here. All right, come on. There you go. There you go. Minus the costs, okay? If you're following me here, you want to do the minus without getting an error message, you have to put a apostrophe in front of it. I hope you learned that in Excel somewhere. All right. Sales minus costs, okay? Now, notice, and you're going to have to do this for those problems, notice that the depreciation was separate. It was given separately. So the depreciation goes right below here. This is financial accounting, friends. So if you are a little anxious in seeing what I'm doing here, I'm telling you, you've seen this before, okay? We just built in here a cash flow statement. Well, first an income statement, and then we're going to go to the cash flow statement from the income statement. So be careful here. All right. Sales minus cost minus depreciation. So there's nothing else given here. Okay. There's no taxes, no interest. Okay. So then you can do here equal your net income. Reminding you the net income is the after taxes, after interest, after a bunch of different things. Right. Unusual items, you know, etc. But we're not gonna make it here that complicated, right? All right. Now, let's compute the net income based. What do we have? But we have to keep on going a little further. But let's give now. Let's put some numbers on the table for now. All right. The question is, how much is the sales on year 0? Well, in year 0, you have no sales. Okay. On year 0, you have no costs associated to sales. You have investment costs, which is coming on the cash flow analysis. On the income statement, you only put sales and costs incurred after the project has started. Year 0, you have nothing. So it's zeros all the way around. Okay. That's right here. I'm going to make those numbers to be in the center. Hold on a sec. There we go. There you go. Perfect. All right, now year 1, 2, and 3, you will have sales, you will have costs, you have depreciation. So let's put it. Year 1, you have $50,000, okay? On year 2, you have $100,000. And on year 3, you have $400,000. Okay, $400,000. Right. What are your costs? Right. Your costs are 10% of the sales, incremental sales. So all you have to do is this: get skilled enough on Excel, and it's about time for you to get these basic skills on Excel. Equal 10%, which you can put 0.1 times the. Just click on the cell above. Okay. Then you have 5,000 here. There you go. So 5,000, 10,000, 400,000. I like it to do in red. One is costs and depreciation. I like to do it in the color red. Okay. It's easy for us to see. Okay. All right. And what about depreciation? It only happens 1 year after, right? So it happens on year 1. You purchase today, you depreciate it. The depreciation kicks in 1 year after. 1% of sales. So equal 0.01 times the sales. Be careful, don't not click on the wrong cell. Sales. There you go. And that's the depreciation. Okay. Usually the depreciation is a straight line format. Now could be here, it's going to be $500 every year. Okay, or it's going to be 1/3 of the total investment. So the problem can make it a little bit more complicated for you, but the idea is the same. All right, let's see how much money we made in profit after taxes. But there, for the sake of the example, there's no taxes. Sales minus cost minus depreciation. Okay, too much. Let me open here a little bit. There you go. So this means you made $44,500 on year 1, $89,000 in profit on year 2, and on year 3 you make $356,000 in profit. All right, we're almost done there. Okay, because I'm okay. How many more minutes do I have? Okay, I have 8 minutes. It's plenty. All right. Okay, so I'm just going to give you one more time what are we doing here for those that are lost. We create an income statement to find the profit that the new project is going to give it to us. Now we want to know, and you need to remember this, it's about time for you to be very comfortable. The profit, it's not cash. Okay. Profit is not cash. So it doesn't mean that you have 44,500 in cash. Okay. It doesn't mean that you have 89,000 in cash. Imagine if this was all accounts receivable and nobody paid you. So even though you reported a profit of 44,500, nobody of all say the sales that you reported, nobody paid you, then you have zero cash. Okay. So it's possible to have zero cash even though you had profit. I hope that's very clear for you. Okay. So how we determine the amount of cash in that situation? Now we have to make an analysis on the incremental costs related to the project itself, related to the inventory that you're going to need to purchase to keep this expansion going. Okay. Do you need to buy more machines on year 2 and year 3? Okay. This is all cash flow because those are investments. Right? You need to remember cash flow from operations, cash flow from investing, cash flow from financing. All right. You can put right below here, okay, what we call add the depreciation. Okay. Why add the depreciation? Because you need to remember the depreciation is not a cost that you write a check for it. Depreciation is a number that you include in your income statement, so your taxable income is lower, and therefore you're going to pay less taxes. So I would say depreciation is an incentive for you to pay less taxes on the corporate level. Right? It doesn't apply for income taxes, just for corporate taxes. All right. So because you don't pay the depreciation, you have to remember this from managerial and financial accounting, you have to add the depreciation into your income to figure out how much cash you have. Assuming that all sales were in cash, okay, then all you have to do is adding the depreciation. So here will be equal. Because the numbers are negative there, I'm just going to copy them here. So 500 for this depreciation, 1,000 for depreciation in year 2, and 4,000 on year 3. Be careful, this step is extremely important, okay? Because you're going to have to remember your financial accounting here, friends. So if this is confusing, if this is difficult or getting a little bit challenge for you, it's because the knowledge that you needed from financial accounting that you're not remembering, right? That's normal. It happens because some of you might have taken financial accounting 2 years ago, 3 years ago. Therefore, I understand if that's the case. So there's no depreciation in year 0. All right. Now is the inventory requirement. Inventory requirements, you have a name for that and you need to memorize that. This is called net working capital requirements. Okay, net working capital requirements. Thinking on inventory. Do you need inventory every year? Probably you do, right? You probably need inventory because you need to sell, right? Every year. So you're probably going to need inventory. Can I find this one? You're going to need net working capital requirements every year. So let's see what is the problem given to us. Look at the problem is given to us. That the net working capital, let's see. There you go. Inventory requirements, 5% of sales. All right, 5% of sales. You don't. Now, do you have net working requirements on year 0? Think. Do you need to have the inventory on year 0? The answer is yes. Most likely you have to purchase the inventory before you start selling, correct? So that's an assumption you need to make here. Because we buy the inventory, before we sell, before we make any sales, right? Imagine that this is a manufacturer. So they cannot buy the inventory ready to sell, right? They're going to have to do some kind of production. Therefore, they will make it more visible here for you. There you go. Therefore, they will have to spend inventory, okay, on year 0. Now, according to the problem, because it was a very simple problem, right? There was no net working requirements, okay, or inventory requirements on year 0, according to this problem, okay, because you have to follow what the problem is telling you, 5% of sales. There's no sales on year 0. There's no requirements of net working capital inventory, for example, on year 0. Now, how could be an example? That I sell, I'm a retail. So I just need to purchase the product already made and then resell it. So this could happen on the year 1 instead of year 0. All right. So 1% of sales is inventory. Okay. Inventory requirements. Okay. My example of, let me make a parenthesis here because I like to make this real life approach. My example of retail would work here, except that it's very rare to find a retail that will spend only 5% of their sales on inventory expenditures, right? Cost of goods sold. But is the example I have here, that's the example, that's the numbers I'm going to use. Right, 5% of sales, it's 0.05 times 50,000, which is the sale for year 1, sales for year 2, year 3. All right, friends, because you pay this, right? Those are net working capital. Those are inventory requirements. It's a negative number, okay? And finally, I'm almost done here. The fixed, or let's say capital additional, or just put capital investment to make it simple here, because otherwise it's going to be too long. Capital investments are equipments and machines or fixed assets purchased, okay, to have this project. Under the, and be careful here, because a lot of students miss that number, okay? The capital investment is your outlay, how much you need to buy fixed assets. So let's say, because I didn't give the number here, was 100,000. No, I think I gave you that number. It was an initial investment. There you go. It's an expansion that requires 500,000 in fixed assets. All right. So this is, according to the problem, is done on year 0. So here you put minus 500,000, or yeah, minus 500,000. There you go. Yeah, bear with me here, friends. I might run out of time, couple minutes, but this is important. It's a complex problem, and it's 25 points on your next exam. I want to make sure you get the proper understanding here. All right. What is the capital investment on the following years? According to the problem, we don't have. We're done. Now let's add those numbers and come up with the cash flows. Okay, it's the next line here. We call that cash flow from assets, CFFA, cash flow from assets. Get the names. All right. The cash flows from assets, you're going to start here in this portion that I'm highlighting here for you. Okay. This portion in green is where you're going to compute your cash flow from assets. So take a look. Equal net income plus depreciation minus net working capital requirements minus initial investment. Be careful here, because this is going to be a little mistake that some of you may make and get the wrong problem. Notice that I put a minus on my 500 here. Okay, I put a minus here. Therefore, I must put a plus here, okay, to get that answer. So be very careful. Now, if you want to avoid this situation that I just created for myself here unintentionally, go ahead and remove the minus from here. Keep it red. Keep it red. So remind you that's a minus. And down here on the formula, put a minus there. Then you avoid this little thing. Okay. The first number is always negative, precisely to avoid the mistake on IRR that I showed you when I was doing the feedback on the chapter 8. All right. If you did this properly, all you have to do is copy this. There you go, friends. And those are the cash flows from this problem. Look at that. Okay. With a rate of return of 15%, I'm going to compute for you here the NPV. Okay, so the NPV is going to be equal. Okay, now be careful. I'm going to do NPV one more time, because again, it's easy to make a mistake here. Quite easy to make a mistake, to be honest with you. Equal NPV, open parentheses. What is the interest rate or the rate of return? 15%. Put it there. Comma. Value 1, not value 0. Value 1, 2, 3 are those cash flows here. That's it. Only year 1, 2, 3, 4, whatever, but not year 0. Okay? Now I have to minus that investment. That's another mistake students make sometimes, is that they put a minus here and they click on that number. Okay, you're going to make a mistake if you do that, because minus with minus is a plus. So, and you want to leave the number negative for the next formula. So here you need to remember that you have to put 8 plus and then click on that number. If you're doing this way, right? Right, look at my, it's a very ugly number because of the decimals, okay? So I'm gonna make this number a little bit more visible, and please round these numbers for me, okay? Round this number for me on your exam, okay? 2 decimals okay, no decimals preferable. There you go. So look at the answer here, friends. It's a bad project because we spent 500,000, okay? And then we make this much. All right, I'm gonna have to finish, unfortunately. We are above the class time by actually quite a lot, okay? 7 minutes. Again, I don't like to say apologies because, I mean, again, you're gaining. It is gonna be helpful for you somehow, hopefully. So don't be mad that I spent some extra time. For the future, okay, if you have to leave on the time of the class, just go ahead and do it. I will not penalize you for that because I understand you might have something to do. All right, the IRR here will be easy, okay? It will be just equal IRR, open parentheses, and this, you highlight everybody in the pool. Everybody in the pool gets highlighted, and then you're gonna get a negative IRR, which is very, very bad. It's a bad investment, okay? There you go. Okay, friends, I'm gonna have to stay here. I would like to stay longer because I like this topic. I like this stuff. This is actually something I enjoy. There are other things that I wanna talk about, especially the final project. I'll do this next week. All right, yep, have a good weekend. Stay if you need to ask any question. Class is dismissed for the others.
Thank you, Professor. Have a good day.
All right, good. And that concludes week number 9, financial management. The topic of today was investment decisions. It was chapter 9, okay? NPV, IRR, and projects, cash flow of projects. All right, and that concludes the class.